Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of MF Corner on YouTube. Now, what we're going to be discussing today is going to be the psychology of investing in mutual funds. It's very important while you're investing as well. While we may not pay that much of an attention, we pay attention to ratios, but how important is the psychology of an investor? To talk to us about all of that, we have Ajit Menon, CEO at PGIM, India Mutual Fund, joining in with us. Ajit, thank you so much for joining in with us. And, this is something that people normally don't talk about or aren't aware about this situation. What I want to start about is, what are the most common behavioral biases that affect mutual fund investors that you have seen over a period of time, and how do they influence the investment decisions that they make?
Firstly, Vinnii, thank you for having me on the show. And yes, this subject of investor psychology and how that affects our investments is a topic that has fascinated me and many like me, especially when we see the volatility and how investors respond. I would probably say that, as a starting point, much of what we know about investing has largely been driven over many years in a very economic numbers sense, and it's only later on when scientists like Daniel Kahneman and Richard Thaler and the others, when they won their Nobel Prizes for behavioral economics and behavioral finance, that one started understanding that there are psychological biases that affect investors as well. And to your question about, what are some of those biases that can affect people, some of those which are very common could be things like what's called herd behavior, which is that we just follow the tribe, we just follow the herd. We feel that everybody else around us, our friends, whatever's happening on our social media and WhatsApp, there's so many recommendations, and we sort of tend to think that let's just go with the herd. So herd behavior is one bias, that we follow others. And the second one, of course, is something called recency bias, which affects a lot of people. It affects human beings in general. Recency bias essentially means that things that are happening recently in the environment around us, and I think the current environment is a big example of that as well, can affect our decision making for sure. And I would say that because of that recency bias, if we feel either scared, or some of those recency biases could be the markets are booming and we feel that we need to participate in a big way. So those things can swing our outcomes for our investing. And I would say the third one, in a simple sense, is loss aversion, which is what people go through when they think that, they react more to losses than they react to gains, right? Nobody wants, obviously, to lose their money. And so any amount of loss beyond a certain tolerance or, beyond a certain level is something that impacts our decision making. So I would say these three kind of biases, herd behavior, recency bias, as well as loss aversion, these are things that can impact our decision making and ultimately the outcome of our investments as well.
Absolutely important ones highlighted: herd behavior, recency bias, as well as loss aversion. Ajit, I'm going to pick up herd behavior first, as well as recency bias. How can one actually overcome these situations, right? Herd behavior is more like because of fear of missing out. Oh, everyone is doing it. Even I want to do it. It is
Absolutely.
natural, right?
Yeah.
How do you overcome these behavioral traits? That it's human nature. You can't stop this. So how should one process through this?
You cannot. You're absolutely right. And in fact, when I was talking earlier about people who won the Nobel Prize on understanding this, which is people like Daniel Kahneman, especially speaking about Daniel Kahneman, and he unfortunately passed away last year. He himself says that it's not about you taking, rational decisions on investing or emotional decisions on investing. He said, we are humans. We will have these biases. And he said that he himself is also subject to these biases in his decision making. It doesn't spare anybody, experts or novices or and all of us as common people. Your question, however, is, how do you overcome these biases? And I would say that I would cite my own example. I have I have been about 31 years in my career, out of which about 26 years has been in mutual funds. I've been the CEO for PGIM for the last 8 years. But I do not make my investment decisions at all. I have a financial advisor who my wife, my family has been having for the last more than 14 years now. And that's the way that I have sort of thought of how can I manage these biases, because it's your money and you're going to be emotionally connected to that money and what happens to it. But if you can have a trusted advisor, somebody with whom you feel the comfort of how they manage risk and how they build for you, help you manage your portfolios, it's better than to sort of outsource that risk of biases to a professional who you understand, who you trust, and who understands how your goals are planned for you. So I would say that the number one way of overcoming these biases would be to have a trusted advisor and somebody who you are in sync with from a risk management, how they do manage risks in general, and you feel comfortable about that. A second also simple way to do this is many products within mutual funds, especially, have built-in features that allow you to control for the risks that these biases can have on your investments. And to give you a simple example, we know that in mutual funds, you have a category called the balanced advantage funds.
Right.
Now, a balanced advantage fund is a category where, and many fund houses have their balanced advantage fund. Each of them will have a sort of formula to control the exposure to equity and fixed income and balance that asset allocation based on how the market is doing. If the market's too expensive, they may reduce the allocation to equity. If the markets go cheap, based on whatever is their parameter, they will buy more of equity. And I think that allows you to have a better, what's called risk-adjusted return, not the returns that we see all over, but a better risk-adjusted return. So investing in products or taking advantage of some of these built-in features in mutual funds is a beautiful way also to take care of the biases. We know about SIPs, for instance. It's actually a discipline, right? It allows you to have a discipline where you don't have to take a decision every month whether I should put some money from my salary or not. You're investing in a disciplined way. And what that does is that when the markets are cheaper, your SIP will buy more units.
True.
When the markets are expensive, the same amount of that SIP will buy lesser units and therefore average over a period of time and give you a better outcome for your investing. So 2 ways: have a trusted advisor, which I do. And the second is alongside that, even advisors use these products and you can use them too and understand the built-in features. Let me give you one more very simple feature. You want equity exposure, you're thinking of different kind of equity funds. If you think about the multi-cap category of SEBI for fund houses, it has a criteria that you need to have a minimum 25% in large cap, 25% in mid cap, 25% in small cap, and the fund manager can decide how the last 25 is allocated between the three, but you will get those minimum allocations. So it gives you a feature to say, hey, I'm going to participate in all the three market capitalization in a diversified product. And if I'm using this for long-term investing, this becomes a great feature of the product so that you're not deciding, whether you want to go this way or that, and the product takes care of it.
Absolutely, great points and great strategies coming in, right? There's no way to control your emotion, but financial advisor, surely getting a help of a financial advisor is always helpful. Balance advantage funds, because that is something you can look at, and multi-cap, because there is an option to invest in everything. So maybe your emotions could be in check. If there's a multi-cap fund, it's invested across the board. So you're not missing out also, but you're not gaining too much. You're missing out, not a worry in terms of risk also.
That's right. These are like fill it, shut it, forget it products, right? A hybrid category of funds are pretty good to do that.
Absolutely, Ajit. So, Ajit, while obviously we do have fund managers also which are privy to, this emotions, right? Loss aversion specifically. Everyone wants to avoid loss. So, for loss aversion specifically, that's the most basic thing, that I want to make money. It comes and relates to your return. No one wants to make a loss. Is there anything one could follow for that as well? Or is there a tool that you follow, maybe specifically on a personal level?
Well, I think whenever we talk about loss aversion, while losses can happen in multiple different asset classes, I think what you are asking as a question and what our audience would like to know is always connected to equities, right? And my personal reason for owning equities at a very first principles level, and I would say that that's the conviction you need to have when you're investing in equities. My personal conviction is equity is the only asset class that captures human progress, right? In the sense that you had COVID, you had vaccines, and pharma companies would have had that innovation and taken advantage, built profits based on that. You see new technologies in various areas. These are the profits that are built around these new innovations in every sector is captured in equity as an asset class. So really human progress is captured in equity. It's not captured in the same way when you think about gold or real estate or commodities and things like that, right? Which are also investments that people do. So first is to have a real conviction on why are you owning equities in the first place, and I talked to you about mine. The second is when we're thinking about loss aversion, and as you mentioned, nobody wants to make losses, but if you're in a market, you're going to be having that volatility from time to time. And how do you take care of that? When we say loss aversion, well, you're talking about not wanting to lose your capital, and sometimes you're okay with a little bit of volatility. It's different for different people. You just don't want more. One could be going back to the earlier answer of saying use products that have inbuilt features that can limit the outcomes, negative outcomes for you much better than you can do yourself. I think that's, the big one. The second is to realize that if you have your personal conviction in equity, then when there are corrections in the marketplace, you're basically getting equities at a discount. I think, Winnie, this is a very important fact. You see, for thousands of years, when human beings have always known of investing into gold or land and real estate, we always look for saying that if the prices are down, I'm going to buy more gold. If the real estate prices are down, I'm going to buy, I might look to invest in real estate. I'm not looking at these, especially when they're at their peaks. But when it comes to investing, for some reason, we are chasing returns. The higher that we think that this is going to last forever, and we jump in. And when the prices are down, we panic or we feel this whole loss aversion hitting us negatively. The way I look at it is that if you know your goals, if you know your time frames, then use this as an opportunity to actually build more units of your mutual funds that you already own. I think that's the way to deal with it, because what I would say is that if you're panicking because of loss aversion bias and taking money out of the market, there is enough research to suggest that even if, for instance, and I remember a recent article that Devina Mehra had written in the Mint, and she said, listen, if you go back 40 years in the Indian stock market, and if you had invested 100 rupees at the start, you would be sitting on 75,000 rupees today. But, if you had missed just, 30 days out of the 40 years, just 30 days out of the 40 years, you would be left with just 7,000 rupees. Right? So just think about it. Or if you'd missed just the best 10 days of the market, you would have left with just 25,000 rupees. You would have lost 2/3 of it. So staying invested, and especially when you see markets correcting, imagining or thinking about it that, good equity, which captures human progress, is available at a discount, and either let me hold on to what I have or maybe add based on my time frame. That's the way to probably approach it. And otherwise, the simple way is to use products that have features, as we mentioned earlier.
Absolutely. Ajit, just the last question on this front, rebalancing your portfolio. During that time also, because those could be emotional as well, you're rebalancing your portfolio because you're worried about something. It could be that case as well at some point of time. So for that scenario, are there any predefined rules that, or a checklist maybe one could follow when they're rebalancing their portfolio to avoid such a scenario?
Well, talking in very general terms, Vinnii, many people sort of use this to say that let's start with portfolio construction before the portfolio rebalancing aspect. And if you were to use a simple thumb rule, which people use, which is 100 minus age, could be your allocation to equity. Some people use 110 and so on and so forth. But just look at it simply. 100 minus age should be your allocation to equity, which means that if you're a 30-year-old, 100 minus 30, 70% of your money can be invested in equity. So first is getting that asset allocation or the portfolio construction itself in some sort of a rule form. Once you have that, and then you're doing periodic reviews, you come to portfolio rebalancing to say, hey, has my asset allocation shifted? Has the equity gone lower or has it gone higher? Then let me book some profits and rebalance it, or add some money to rebalance it. I think that's the more simple approach to think about rebalancing. Think of doing a review once a year or twice a year. I do it once a year with my investment advisor. That's good enough. Because of all my goals are very well planned, so I know what's happening there, and I think that's therefore important. One can complicate this topic, and I don't wish to, because when it comes to goal planning, one of the advantages when you have an advisor, or if you do your research, you would realize is that based on whatever money you have and whatever SIPs you can do, one can use calculators online to think about what is the return that you require to reach your end goal. It may be 8 years out, 10 years out, 20 years out. If you know that, okay, I need approximately 10 or 11% to get me there, then what you should not be doing is looking at the market and saying, hey, it's booming and there are these funds doing 20 and 30% and jumping in and out of your funds. Don't disturb the sort of 10% plus minus 1 or 2% that the portfolio initially that you constructed could do. Because the simple fact is, if your 100 rupees comes down to 50 rupees, that's a 50% loss. But if you need to take the 50 rupees back to 100 rupees, you now need 100% gain. So, thinking about it, you should not disturb what's called the sequence of return risk, but that's complicated. So just let's leave it at, look at 100 minus age allocation to equity and fixed income, do a review once a year, and if you're higher or lower, rebalance it. That could be a simple approach. And as your age progresses, therefore, the 100 minus age can just help you have a basic thumb rule to do it.
Absolutely, Ajit. This is a great advice coming in as well on what mutual fund investors could actually follow to avoid too much of an emotional decision that is coming in. Ajit, thank you so much for joining in with us on this special edition, YouTube edition of MF Corner. Thank you so much. And thank you so much, viewers, for tuning in as always.
Thank you, Vinnii.
Bandhan Mutual Fund presents MF Corner.